Welcome to the What to Watch video. Every week I do a number of videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. The video I did right before this is called the deep dive video, where I go through the charts that I really didn't talk about in any of the videos. And then the last video that I do is I go through the charts again and I pick out those charts that I'm really honing in on right now. The list is quite positive and it will probably stay positive. Now, the idea behind this video is that I update it on an as-needed basis. However, for the last month or so, I've only done this video once a week. There hasn't been a need to update it during the week. I did look it over this past week when we were shifting more positive, but that was in Friday's session, and I figured I'd just wait and do this for Monday's session. If we start to see a decline, if things start to shift back more negative, I will likely do an update of this video. As long as we stay positive this coming week, I probably won't do an update to this video because the list is pretty long on the positive side. If we start to see some weakness, those things on the positive list are going to shift over to the negative list. This is being prepared for Monday, March 25th. The first area is the positive side of things, and this list is pretty long, where the markets are still anticipating that rate cuts will be slow. When the Fed is coming in right now, as things look at this time, it looks like if they start to cut rates, which they're starting to hint at actually doing that, and the market's really liking that, is if things can stay that way, that would be positive for stocks. Now, if some kind of an emergency event or some catastrophe happens, and anything can happen at any time, and the Fed has to come in and cut rates for that reason, that would shift it over to a negative side. And I have a chart of research to show you that. Sentiment is still extreme positive. We dropped below 75. Well, now we're back right at about that 75 level. If we can still go up from here, and that's positive for right now. If we start to see a decline, sentiment will drop, and then this would quickly go over to the negative side of things. The S&P did set a new all-time high on Thursday, and we had all the other indexes too. The one holdout right now are the small caps. They're not setting all-time highs, but the mid caps are doing well. The NASDAQ and NASDAQ 100, the Dow, they're all holding up quite well right now. The technicals still remain positive. We are quite positive, and we are looking extreme positive to the point where we could say that we're overbought. Now, we can stay this way in a real positive environment. The market can just remain overbought because everybody's trying to get in and keep buying. We're not seeing an awful lot of selling into strength right now. We're not really seeing much of a decline right now either. However, we are in a period which sometimes can lead to some seasonal weakness. Now, in the month of March, we should be just coming out of some seasonal weakness right now, but we've been going up. We're coming into the end of the quarter, and this will be on Thursday because the markets are closed on Friday for Good Friday. Are we going to see some weakness coming into the end of the quarter, or are there going to be some buyers coming in to prop prices back up? That's what we'll be watching. The S&P is still above this long-term resistance. In fact, we're quite a bit above it now. We're up above 5,200 now for the S&P. This long-term resistance that we've been watching was at the 5110 to 5111 level. We're getting far enough above it now, so if we do see a pullback, we'll be watching to see if this area acts now as support. The end-of-day growth and value charts, the ratios that we look at, they're holding up for right now. We did see value really improve over the past week. Growth held up okay and actually improved a little bit. So for right now, on the end-of-day charts, they're looking okay, but they're not really breaking out to the upside. And discretionary to staples also doing okay, still in a longer-term uptrend. We want to see discretionary really outperforming staples. That's what we see in a more growth-oriented environment. And it's doing all right, but not great. And a lot of that has to do with weakness that we've been seeing in Tesla. The S&P is in an uptrend, and I have some trend lines to show you. The S&P is still above. There's two different charts that we look at. We have the 20-period moving average. That's a simple and exponential moving average. We're above that. And then we're looking a little bit better when we do our 20-period moving average study. These are stocks inside of the S&P that are above various moving averages. And both of these are looking pretty strong right now. And the 50-period moving average study, it declined a little bit on Friday because we were down slightly, but it has been showing some improvement. And the bullish percent index is above 50, or excuse me, 70 and still advancing. Now, above 70, that's when we start to get extreme positive. As long as it can continue to go up, that's positive. If it starts to turn down, this will go over to the negative side of things. And then we're looking at the QQQs, which is the NASDAQ 100 or NDX. All of the trends are back to being positive now, and we're back above the 20-period moving average. We had dropped below that. We regained that this past week. And then we did close above some short-term resistance. These are based on daily pivots. And we're also above long-term resistance that we've been following, and I'll show you charts of those. And then the ratios that we've been following that mainly apply to the QQQs or the NASDAQ 100, they are improving. So this is the chart that shows the research based on if the Fed can come in and cut rates more slowly, this is more positive for stocks. If they have to do it because of some bad thing that happened, then that tends to be more negative for stocks. This is sentiment where we came back up to the 75 level. We dropped down a little bit because we declined on Friday. If we continue to fall, this would turn more negative. Right now, we're just looking quite positive. This is the long-term resistance, and I'm still calling it that for right now. This is the weekly chart that I've really been focused on, and these are pivot points that are good for the whole month. The neat thing about pivot points is these are on the chart before we even get there based on time or price. And the reason we've been watching this, because we came right up to a monthly pivot back in 2021, and that marked the high before we had a really difficult 2022. Then we were starting to bounce in 2023. We came up to another pivot point and then started to decline for a few months before we started the advance that we're in right now. We danced around this level, a little bit above, a little bit below. Well, now we're starting to break out above this level. So that's positive in and of itself. If we see a decline, we're going to be watching around this 51.10-ish to 11-ish level to see if it ends up providing support. Now, the longer we stay above this, the more likely this is to become support. There may not be enough time that has passed for right now. And then this is some end-of-day charts showing small cap growth to small cap value, where value did really outperform later in the week, but we're still doing okay. We shot up. We're going sideways with this trend. We're not really seeing much of a breakout with the small cap index, and this is the lagging index. We're looking a little more positive when we compare mid-cap growth to mid-cap value. This is in a more solid uptrend, and we're also coming off of setting recent all-time highs. This is the one that I focus on. This is S&P growth to value, where we showed a little bit of a tick up on Friday. We have been in an uptrend overall. We want to see this improve. Now, there are times when this ratio goes down and the S&P still goes up. So the market can still do that. It's a lot stronger when we see this ratio going up and the S&P going up at the same time. Then we want to keep an eye on discretionary versus staples. The discretionary is still outperforming longer term. It declined a little bit on Friday, but we want to see this doing better. And if Tesla could start to rebound a little bit, that would really help this ratio quite a bit. These are the trend lines I've been talking about. I drew a low from a line from the October low, and then these were a series of lows that we were hitting. And this is when we were really moving up with some real fierce action. Well, then we started to drop below that, and then we set another series of lows here. So I drew this blue trend line. We're right in between the two right now. But no matter how you look at this, we are in an uptrend. Then this is the 20-period moving average study. We're above both lines. The reason we're watching this, it's positive right now, but if we start to fall and we drop below the trend lines that I just showed, this might be the next area that may offer some support. And then we're looking at the stocks inside of the S&P 500 that are above or below their 20-period moving average. And it got up to a pretty high reading. It has dropped back now, but overall, this has been showing some improvement. But even longer term, we're still looking at this negative divergence here, just something to keep an eye on. This goes back into November and into December. The further we get away from this, the less relevant that becomes, but we still want to keep an eye on that. Mostly, we want to see this going back up, and that just shows that the short-term trend is more positive. Here's the 50-period moving average study. Also declined a little bit on Friday. has been showing some improvement. Also seeing a longer negative divergence here. If we can stay away from that for a while, that would kind of not be relevant anymore. But we want to see this continue to go up, and it has been improving. And then this is the bullish percent index. We're above 70. That's when we start to get extreme positive. And even with the down day, we did see this going up. Now, as long as this keeps going up, that's positive. If this starts to turn and come down, that would be more negative. And then it actually becomes a sell signal if we drop back below 70. The thing I like about the bullish percent index is this is not moving average based. This measures the point and figure buy or sell signals that are generated inside of the S&P 500. So instead of it being really lagging like moving averages can be and oscillators can be, this is telling us right now what's actually happening. And that's why I really like this. So we'll be watching this really closely. And then the NASDAQ 100, and it's kind of a mess over here. There's so many lines up here. We have a pivot point, and this has become pretty positive or pretty influential for the NASDAQ and the NASDAQ 100 are these pivot points that we see. We came up to this pivot point, and then that acted as overhead resistance, and we fell back. Then we came down to this other pivot point, and that acted as support. Well, we were able to get above this pivot point, and it might be really hard to see this. We closed right down on the pivot for right now. So that is positive. We want to see if this area can hold, and then the NASDAQ 100 break out above that. If we start to drop below this, that would turn things slightly more negative. Here's the QQQs where we had fallen below the 20-period moving average. And in last week's video, I think I said it wrong. This is a 20-period moving average of 50, and the 200 is on the bottom. We fell below this 20-period moving average. We were able to get back above that this week, and we're also in an uptrend when you look at all these different moving averages here. This is longer term, a weekly chart of the NASDAQ 100. We're still above this long-term trend line going back to 2009. And then we're looking at a ratio between the NASDAQ 100 and the Dow. We're right up to these previous high readings that we've had in the past. If you're positive, you like this. If you're a perma bear, you're just salivating, thinking that the end is near and their warning signs are out there and the market is getting ready to fall apart. And they might be right, but they've been declaring this for quite a while now and it hasn't happened. But if you keep saying the same thing long enough, eventually you might end up being right. But for right now, this is still looking positive. And then we're looking a little better with our QQQs, which is the NASDAQ 100 to the IWM, which are the small caps. It had been declining, and that was giving us a little concern because the small caps are already underperforming. But now we had a good week with the QQQs or the NASDAQ 100. So we're seeing this ratio coming back up. It's not quite back up to this high reading again, but it has been improving. Now we look at the negative side, and the list isn't very long right now. If we see a decline, this list will become longer. And if it does become longer, then I'll probably update the video as needed. The point and figure chart is still giving us an extreme positive reading. Now that's positive in and of itself, but it might be looking a little too positive. Then we have a thing called the Chaikin money flow, and this looks at things based more on volume. This tries to measure what is the smart money doing. And it's been declining even as we've been going up. And that's another thing that we've been seeing. We had a good solid up week, but it was on below average volume. Some people tend to dismiss that. They want to look at how aggressive is the buying? What's the angle of attack? What are the moving averages doing? I still think volume is something that we should pay attention to. The transports continue to negatively diverge from the Dow and the S&P 500. That's been going on for quite a while now. The small caps continue to underperform. This is really the lagger right now. And now the debate is going back and forth. Now that we may be shifting over to a more positive interest rate environment, is that going to help the small caps do better? Interest rates just kill small cap stocks because they have to do a lot of borrowing, and then they have to do a lot of refinancing, and they're carrying a lot of debt and all these kinds of things. If interest rates can start to go down, this may end up helping the small caps, but that's pure speculation at this point. The dollar index has been advancing, and this can often put pressure on stocks. The stock market likes to have a weaker dollar. It's been bouncing back up and showing some improvement. And then we are supposed to be in a weak historical seasonal time that really didn't seem to develop. And we're wondering, is that going to develop going forward from here? We don't know that or not. We just use seasonality as a guide. I think it's a good guide, but sometimes it kind of leads us astray. And we've been watching this for quite a while now, and it really hasn't followed historical norms. Here's the point and figure chart where we saw some new X's drawn. They're not colored in here. This was earlier in the week. This was after Thursday. And this is good when you see a lot of X's. Now, point and figure charts do not take time into account. It takes price movement into account. Whether it takes an hour or a year, it won't draw a new X until it goes up by a certain amount. And the point and figure chart is looking good, but maybe too good because we have a long, tall up right here. And it's thinking that maybe this is going up a little too far, too fast. Not necessarily a negative sign, but something that we want to respect and pay attention to. This is the chicken money flow, where even though we had a good up week and we've been going up with the S&P, we're seeing this really going down. And that's a bit of a concern. It's still positive, but it's going down. And the red line, which is a moving average, is also going down. This just means that the smart money is not really participating right now. At least that's what this indicator tries to measure. Then we are seeing a longer-term negative divergence between the Dow, which is coming off of setting all-time highs, and the transports, which did bounce up over. They've had a good couple of days, but they continue to go sideways. Now, as we're shifting to a more dovish environment, is that going to help the transports? We want to see the transports go back up and surpass this previous all-time high set in 2021. If it can do that, that would be a Dow theory confirmation. Until that happens, this is a Dow theory non-confirmation, and the perma bears just love to dwell on that. So we'll keep watching this. We look at the small caps, which are in an uptrend when you look at them by themselves, but when you compare them to the S&P and do a ratio, they are really underperforming. We want to see this really go up if the small caps are going to catch fire. And we want to see them outperforming the S&P 500, and they're just not doing that right now. This is the dollar index, which is crossing back above the moving averages. We might see a golden cross here. It hasn't quite happened yet, but if we can stay above both of these lines, this would produce a golden cross, which may put some pressure on stocks. And then here's the seasonality, where in the middle to latter part of March, this is where we often see some weakness. We've just been flying me to the moon, Frank Sinatra style. We're wondering, is that going to develop at some point in the near future? Thank you. I hope you found this helpful. Please check to see if I do updates of this. As long as we're going up, I won't do an update. If we start to see some weakness, then I'm likely to do an update of this video. Have a great weekend, and I will talk to you in the next video. Oh, and by the way, I do update all of these charts in the daily video. That's a longer video, and if you want to see the whole context of everything, please check out the daily videos.